Well, let's bring Erin Gibbs into the conversation, Chief Equity Strategist over at Slatestone Wealth. She joins us here in Studio 2 to count us down to the closing bells. And that really is the big question, Erin. I mean, what is going to be most important this week for the market? NVIDIA earnings or all of these earnings that we're getting out of the retailers?
I think it really has to be NVIDIA. Just when you look at the sheer market cap of NVIDIA, I mean, if you add up utilities, materials, real estate, they don't even add up to the same market cap as NVIDIA. So globally, in fact, it's even bigger than industrial sector. Yeah. So it has so much impact on the broad market as well as globally that it's just something that you absolutely cannot ignore, and I think is certainly going to be more important than consumer discretionary.
What do you make of this idea when you start to hear people reevaluating the AI trade? Daniel Pinto saying AI needs a reassessment, a big downgrade at Redburn today on Microsoft and Amazon, and a lot of people now who seem relatively bullish just, I don't know, even a few weeks ago, now seem to be saying, wait a minute, how far have we gone?
Right. I think a lot of those conversations have started, and I was warning this beforehand, is when we started to see accounting changes and then an increasing level of debt. Now, nothing like the dot-com bubble, and I don't want to do any comparisons to it's not the same thing, but the fact that we're seeing a shift in your capitalization, that you're using debt more to fund this, and that also you're changing your depreciation rates. You know, like as soon as you start talking about accounting changes and debt levels, that's something that we need to say, okay, well, your valuations were sky high when you were purely cash positive and you had, very aggressive comps. But now that you're starting to change the books, we want to pull those valuations back down. And I think that's a really important component of this pullback.
Well, it feels like, to your point, we're starting to see that re-rating happen in real time. But I want to talk a little bit more about the consumer because the conversation we keep having is that you think about price levels, maybe they're not increasing to the same degree as they were, but they're still much higher than they were just a couple of years ago. But when you think about 2026 and you wrap in monetary policy, what the Fed's going to be doing, and what's going to happen on the fiscal side, how does that set up the consumer?
So looking at the consumer is actually very interesting because of the tax cuts that are coming through in 2026. We expect refunds to be significantly bigger, adding somewhere between 240 to 280 billion between businesses and individuals. And I think particularly important on the individual side, we're looking at a tax refund average go from about $2,200 to $3,200. So a 40% increase, like an extra grand in your pocket. And we know that consumers like to spend their refunds. They don't put them in their savings account. They go out and spend them. So I think in the first half of the year, as we see those refund checks hit, that we are going to see a nice bump in consumer discretionary. And I think now is really a good time to get into them so that you get the full value as we go into the first half of 2026.
Well, let's talk about that a little bit more, how you translate this into a portfolio. What are some of the names that stick out to you that could benefit from some of those tailwinds you see coming?
Right. So some of that little bonus extra spend money, two of my favorites that have great fundamental stories anyway, are Ralph Lauren and Signet Jewelers.
Okay.
Well, Ralph Lauren is really unique. It's had a great run. It's really unique in that it straddles aspirational as well as affordable because it has those multiple layers of brands. They also have excellent growth in China. So they're just a great story fundamentally. And if you add in this little extra consumer splurge in 2026, I think it'll be poised very well. Another one I really like is Signet Jewelers. They've really been ramping up about pulling back from malls and doing more online. And they have some really strong brands like James Allen and Blue Nile. So as consumers are starting to get more comfortable with buying jewelry online, they really have been at the forefront. And you would think that we wouldn't be talking about companies pulling away from malls and omni-channel in this day and age. Like, welcome to the game, guys. This has been going on for many years. But jewelry has been a little slow to adopt this, and now they are. And we're seeing that growth go with that.
It was funny on the jewelry thing, because we were having this conversation in the newsroom a couple weeks ago when we were talking about kind of the future of malls and stuff. But I thought the jewelry stores were kind of dependent on those walk-ins to a certain extent, because otherwise, how often do you buy jewelry for, a birthday or a wedding or something? It's not you don't necessarily get that impulse buying online.
Right. So bridal is still very key, but that you don't really see that growth. And we know, less people are getting married. It's just that isn't your growth area.
Yeah.
What is your individual purchases, the jewelry that you want to buy for
yourself,
yourself. Exactly. And so that people are much more willing to just go online, get a great deal, and buy. Another shift they've done is
I want a pinky ring, but my wife refuses to let me have one.
I could see it.
She says she can't be married to anyone with a pinky ring. So there goes
all
that.
right, well, you're holding back on that sale. I mean, who knows? Maybe it's the right one.
Sorry, I broke your train of thought there.
No.
You also like gamblers, right?
Yes, those are online gambling. Also, another area where people splurge. So just a lot of opportunities within the consumer space that we could see. And look, it's partially about having good fundamental stories anyway, not just relying on what we're going to see, but I think we're going to get that extra push, and we're really going to see some of those players outperform in 2026.
All right, Erin, great stuff here. I got to talk to what Katie's jewelry preferences are. Erin Gibbs, Chief Equity Strategist at Slate Stone Wealth, helping us